Joining us this morning, one of the key figures behind that downgrade, former Sovereign Rating Committee Chair for S&P, John Chambers, is here with us at Post 9. John, it's great to have you. Thank you, Carl. That's been said a lot lately, but I think your take is if this does get passed, maybe we can not talk about downgrades?
Well, first of all, I would say that the fact that we had this debate and we're still 1 week out and we haven't passed a bill yet, and if we don't pass a bill, we might default, validates Standard & Poor's decision in 2011 to lower the rating. It's simply not consistent to have a AAA rating and a prospect in a week that it's going to run out of cash and not pay its debt. So on that front, I think Standard & Poor's having a AA plus rating on the U.S. is entirely warranted.
You feel vindicated by that call back then?
Yeah, I agree. Now, it's very welcome that we have a bill, and but of course, if we don't pass this bill, you're going to have a default. You're going to have mass turmoil in the markets. You're going to have, even if you have sequestration of ordinary payments, it's going to lead to a recession, and that's a very bad outcome. In terms of downgrades, you've got Standard & Poor's at AA+, Moody's at AAA with a stable outlook. So they're indicating that the rating is not likely to go down. Fitch last week put the AAA rating on their scale on credit watch negative. And there you have a possibility that they might cut the rating like we did in 2011.
Even with a deal signed?
Even with a deal signed.
And that would ostensibly be because of the structure that we currently have regarding budget and debt ceilings? I
think that their analysis was similar to ours back then. You have two major problems. One is the fractiousness of the political environment. The fact that we had a coup d'etat, a failed coup d'etat 2 years ago, certainly would be an indication of that. And the second is the debt trajectory. Even with this deal, if it gets passed, the debt burden, the amount of government debt as a share of economic output is going to continue to rise. And although that in itself is not a problem now, you need a medium-term fiscal correction, because otherwise you're going to use up your ammunition when you do enter into a recession or you have some sort of major problem to face, like a war or something like that. You want to have some dry powder ready for eventualities.
I'll just play the other side, John, as I've done over the years with you on this, and that is, both the politics, which agree it's not ideal, but ultimately we end up reaching an 11th hour deal and we avert default, and then the long-term debt trajectory. Neither of that changes the creditworthiness of U.S. government debt right now, does it?
Well, debt, your capacity to pay debt is in part in function of how much debt you have outstanding. The more debt you have outstanding, the more difficulty you might have rolling it over, the more difficulty you might have in servicing it. That's what the rating speaks to, and it's not the only factor that goes into a rating, but it's an important factor.
But the market hasn't shown evidence of any trouble servicing
the debt.
Well, it does,
and if you look at the credit default swaps, if you look at where the June bill is trading versus the July bill, there's a fair amount of dislocation in the market. Credit default swaps for the U.S. trade worse than a dozen other nations.
But that should come down. That should narrow now, right, after the deal, and if it gets passed?
It'll narrow, but it won't be eliminated. I think that the United States will permanently face a few basis points higher interest costs on its debt for a risk premium. And when you have a stock of debt of $31 trillion, a few basis points is a lot of money.